Welcome to Business with Louis, the show where we explore the world of entrepreneurship and business growth. Today, we're going to dive into the fascinating topic of venture capital, and I'm excited to share with you how it works. So, let's start with the basics. Venture capital is a type of private equity investment that provides financing to early-stage, high-growth companies that have the potential to scale quickly. These investments are typically made in exchange for equity in the company, which means the investor becomes a part owner of the business. The goal of venture capital is to support innovative ideas and help them grow into successful, sustainable businesses. But where did this concept come from? Well, the modern venture capital industry has its roots in the 1960s, when investors like Arthur Rock and Tommy Davis began funding startups in Silicon Valley. Since then, venture capital has become a crucial component of the entrepreneurial ecosystem, with thousands of firms around the world providing billions of dollars in funding to startups every year. One key concept is the idea of risk and return. Venture capitalists take on significant risk by investing in early-stage companies, but they also have the potential for high returns if those companies succeed. To mitigate this risk, venture capitalists use a variety of tools, such as due diligence, to evaluate the potential of a startup before making an investment. Another important concept is the idea of scaling. Venture-backed companies need to be able to grow quickly and efficiently in order to achieve their full potential. This requires a strong management team, a clear business plan, and a scalable business model. Venture capitalists work closely with their portfolio companies to help them achieve these goals, providing guidance, support, and access to networks and resources. Let's look at some real-world examples of venture capital in action. One notable success story is Airbnb, which was founded in 2008 and raised its first round of venture capital funding from Sequoia Capital in 2009. With the help of this funding, Airbnb was able to scale quickly and become one of the largest and most successful travel companies in the world. Another example is Uber, which was also backed by venture capitalists, including First Round Capital and Benchmark Capital. Uber's story is a great illustration of how venture capital can help a company grow from a small startup into a global giant. But venture capital isn't just about success stories. It's also about learning from failures. One notable example is the case of Theranos, a healthcare technology company that raised hundreds of millions of dollars in venture capital funding before its eventual collapse. The story of Theranos highlights the importance of due diligence and the need for venture capitalists to carefully evaluate the potential of a startup before making an investment. So, what are some practical applications and tips for entrepreneurs who want to raise venture capital? First and foremost, it's essential to have a clear and compelling business plan that outlines your company's mission, vision, and growth strategy. You'll also need to demonstrate a strong understanding of your target market, including customer needs, preferences, and pain points. When pitching to venture capitalists, focus on showcasing your team's expertise, the uniqueness of your product or service, and the potential for scalability. Be prepared to address questions about your market size, customer acquisition costs, and revenue projections. And don't be afraid to highlight your company's unique culture and values, as these can be a key differentiator in attracting investment. In terms of research findings, studies have shown that venture capital-backed companies tend to outperform non-venture-backed companies in terms of growth rate and job creation. According to a report by the National Venture Capital Association, venture-backed companies accounted for 21% of the total U.S. GDP in 2020, despite representing only about 1% of all U.S. businesses. Additionally, research has highlighted the importance of diversity and inclusion in venture capital investing. A study by McKinsey found that diverse teams are more likely to outperform homogeneous teams, with a 35% increase in financial returns. This emphasizes the need for venture capitalists to prioritize diversity and inclusion when evaluating investment opportunities. As we wrap up today's episode on how venture capital works, I want to leave you with a key takeaway. Venture capital is all about supporting innovation and growth. It's a critical component of our entrepreneurial ecosystem, and it has the power to transform industries and create new opportunities. So, if you're an entrepreneur or investor looking to make your mark, remember that understanding venture capital is essential for success. Whether you're seeking funding or looking to invest in innovative companies, it's crucial to grasp the principles, theories, and best practices that drive this industry. Thanks for tuning in to Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.